To me, I think the most critical conversation is an understanding that sustainability is not a values proposition, and that is actually a critical component to thinking about investing in business. That's a difficult concept, and a lot of folks are skeptical about that. They're skeptical because historically, actually, sustainable investing has been about negative screening, about taking away opportunities as opposed to using sustainability as a lens to help make better investment decisions. And ultimately, that is, frankly, that's one of our objectives as an organization, is to prove the business case, to prove the investment case that sustainability adds value as opposed to take away value. So it's critical that you all have this conversation and debate internally with the investment team on really whether this, in fact, can be a tool to make better investment decisions. Then the next challenge is, if you believe that, well, how do you deploy that across all asset classes? That's not straightforward. And particularly in the case of CalSTRS, because you are, in fact, often the market. You need to be invested in almost everything. And therefore, you have risks and opportunities, but risks that you have to consider because of the fact that you will own lots of different things. Generation has an advantage. We don't have to. We get to choose the things that we invest in. But nevertheless, an understanding of sustainability across the portfolio and the risks and opportunities associated with that will be critical. The last thing, and Al alluded to it, I just want to underscore how important it is. CalSTRS is a global leader in investing. Already true, Jack and Chris, no question about that. As you all transition more to sustainable investing, that will set the tone for many institutions in the world. It is a big deal. The reason why we're here, we're blessed to be partners with you, but this is an opportunity to have an important conversation with one of the most important investors in the world. If you all consistently ask your managers, how do you think about sustainability? How do you think about carbon risk in your portfolio? You will be doing the global economy, in the business community, and the investment community, a very big favor.
You good, John? Okay. Betty?
Thank you. Thank you, Vice President Gore and Mr. Blood. My questions revolve around, I guess, just the terms of engagement. And as we look at, and I do agree that we have a tremendous opportunity and can continue to lead with respect to our decisions as a fiduciary board. But it really relates to if we're going to look at being a significant part of reducing climate change risk. How do we engage fossil fuel companies? Do we engage them directly to be part of entering this new phase of opportunity, or and we're going to have conversations about divestment with our friends in the legislature. So I'm just curious about what your perspective is on that.
Well, if I can start again.
You're the chairman, you get to do that.
Yeah. Some investors buy the equities of companies whose business models or plans they don't really like that much, but use their ownership as an opportunity to harangue them or try to persuade them in various ways to change their behavior. We don't do that. We sometimes end up talking with companies if they're not taking the kinds of steps that we thought they were going to take to unlock the value we thought we saw. But that's not our model. I sometimes hear institutional investors say, well, if we don't own the stocks of this company or this industry, then we won't be able to influence them. I don't want to dismiss that argument out of hand, but in my experience, going back a few decades now, I have been less than impressed with the willingness of carbon-intensive companies to play a meaningful role in bringing about change. I have seen some of them play a very good game. I've seen some of them make some interesting moves and then abandon them. I've seen many of them try to give the impression that they're part of the solution instead of part of the problem, but not many of them really actually walk that walk. And I was at the World Economic Forum a couple of weeks ago in Davos, and one of the large oil companies there was asked about stranded carbon assets, and is it true that this poses a risk that your business model is time limited? And he denied that there was any truth to that at all. Nick Stern, the great British economist, was asked, and he recalled the story of the British socialite that some of you may or may not remember reading about, Mandy Rice Davies, who had apparently had an affair with Lord somebody. And the Lord somebody was asked in court, is that true? And he denied it. And Mandy Rice Davies said, when she was asked in court, what about his denial? He denied it. And she said, he would, wouldn't he? And I think that the position now being taken by many of the carbon-intensive companies is entirely predictable. They would, wouldn't they? Deny that there's any problem? Of course. Are they likely to be a part of the solution? I doubt it. Everyone would certainly welcome it, but it's most unlikely. The CEO of the largest oil company, ExxonMobil, said recently, and I'm going to give you the exact quote because it was kind of a puzzler to me. He said, and I quote verbatim, "What good is it to save the earth if humanity suffers?" I really don't know where to start on that. But my point is, I don't think they know where to start. Now, our view on divestment is that it's for you to decide, and I know it's a current hot controversy, and I don't want to complicate your lives. We don't think it's an all or nothing proposition. Many entities are divesting from the most carbon-intensive resources first. But the larger point that I'd like to convey here is that and David said this, it's not trading values for value. This is a straight-up business proposition. You've got to analyze the risks with a very clear view. There's something you know very well from behavioral economics called an endowment bias. If you've always owned something, there's a reluctance to not own it anymore. And there's a tendency to overvalue what you already own. We're at a historic transition point. We cannot continue using the Earth's atmosphere as an open sewer spewing 110 million tons of gaseous garbage into it every day. We cannot continue doing that. And there are multiple pathways to stranding. I mentioned some of them. People talk about the passage of laws and regulations and mandates to reduce carbon emissions. That's one pathway. People talk about the public support for change, as evidence in that New York march, as evidence outside this building earlier today. That's another pathway. But there are market pathways to stranding. As the former Saudi oil minister famously said, the Stone Age didn't end because of a shortage of stones, and the oil age is not going to end because of a shortage of oil or coal. Something better is now available. I'm sorry to be long-winded on this, but we see it as a business proposition.
Harry.
Thanks, Sharon. Just a comment and then my question. Thank you, Mr. Blood, for being here. And Mr. Vice President, it's a thrill and an honor as a U.S. government teacher to have you here with us today. As I said to you in the back room, I remember very fondly where I was in 1992 as the rain fell in Little Rock, Arkansas. We played Fleetwood Mac. I'll never forget where I was. It was a great 8 years of peace and prosperity. And I want to thank you for your distinguished service to our country as the Vice President, as a U.S. Senator, as a Congressman, and your father's service to our country. And congratulate you on your Nobel Prize. It's really terrific to have you with us. And I can't wait to share with my students at Santa Monica High School. We had an opportunity to hear from you today. And your future, you may have a future as a preacher. There might be a preacher in you. You almost had me at an amen there at the end. But having said that, I do think, there's in politics and in investments, there's some similarities, and that's that short-termism. It's the quarterly reports that the board and the CEOs and, in the rapid news cycle, everyone's worried about the quarter, and everyone most politicians are worried about the next election. We, on the other hand, I believe have a great alignment with the issues that you have raised. As a long-term institutional investor, we have that long-term horizon, and we have a tremendous opportunity to address current and future risks, and to be forward-thinking as a board about an issue that is indisputable and basic math. If you just think about the world's population, its growth, and natural resources. It's not that complicated. I grew up in New York. In 1963, I was born. I used to go to Rockaway Beach. It was wiped out by Sandy. I could not believe my eyes what I saw. I have 2 daughters. So I need to think about, how do we as a board who are entrusted with the retirement security of California's educators to make sure that we have the assets in place to pay the benefits to people who have earned them, but do it in a way in which we are looking forward to the risks that currently exist. So to get to my specific question, how do we as a board, as a policy-making board, we entrust Mr. Ailman and his investment staff to deploy the capital and make it work for us and make it for our beneficiaries. How do we as a board address policies, fiduciary duty, and then based upon a conversation I had with a professor at Rotman Institute recently, he pushed us to think about, and Ms. Hendricks was there with me, to think about fiduciary duty as trustees as an evolving principle, similar to whoever thought that blacks would have the right to vote, women the right to vote, GLBT rights. That fiduciary duty and responsibility is the evolving principle, and that climate risk and other risks are fiduciary duties that we have to look at, but the need for us as institutional investors to collaborate with other large institutional investors to make a dramatic change in the impact that we could have on the globe, the economy, and on human life and the quality of life. So that's long-winded, but I think if you could give us some general thoughts around that. Thank you.
Well, I think the place we would start is that we categorically believe it's your fiduciary duty to integrate sustainability into your investment decisions. We believe that because we think sustainability is relevant to the long-term success of businesses, and as long-term owners of those businesses, you need to understand holistically how these businesses operate. We think increasingly that a broader group of people understand that. The CEOs of the very best businesses in the world actually understand that, which is why that they are operating their business in more sustainable ways, although not all businesses by any stretch of the imagination. But this is not about values. And it's important that we always go back to, why do we integrate sustainability? Why should you consider sustainability? Because it will allow you to make better asset allocation decisions over time, and specifically within managers and companies, better security selection. So this is, for us, always been about what is best practice from an investing perspective. And what we're trying to prove with our investment processes and our conversations, and Lord knows we need to keep getting better at it, and I certainly need to try to be more articulate about the business case, but we think the business case is strong, very strong, and you need to debate that with Chris and the team, but ultimately, we think it is your fiduciary responsibility.
If I could just add to that, I agree, of course, with everything David said, but you're asking also about what you can do, sitting there and discharging your personal responsibilities, overseeing this. When I was a member of congressional committees and subcommittees, House and Senate, I was often struck by the power that could be wielded with well-framed questions. And you have the opportunity to ask questions that may make the generalist background that many of you have a strength in guiding CalSTRS. You're blessed with a tremendous staff, and we bragged on Jack and Chris, and it's sincere, and their team is really fantastic. But when we started working together, David and I, one of our founding metaphors, and forgive me, this sounds a little geeky, but maybe there are some science teachers in here. But I learned this from a science teacher a long time ago, when what was being discussed was the electromagnetic spectrum, and there was an aha moment that most teachers who cover this try to convey. You go, it's normally a long, flat rectangle with all the different wavelengths of, infrared and ultraviolet and radio waves and microwaves and all of that. And there is a very thin, tiny slice that is made up of visible light. And when you see that, well, what about the rest of it? Well, it's all there. And when I had the chance to work in the White House for 8 years, I started every morning with an hour-long briefing from the intelligence agencies that, as you may have read, collect data from the entire spectrum. And the picture presented was a lot more complete. Now, why am I telling you this? Because in the investing process, again, your team is an exception, but it is very common for people to focus on a very narrow slice of the value spectrum that's visible because it's on the Bloomberg screens, visible because it's in the quarterly reporting, visible because it's measured incessantly in the numbers that are commonly used. But the rest of that value spectrum is still there. And some of the things David was talking about, how do they manage their employees? How do they treat the communities where they live? What about their carbon footprint, et cetera? That is often more relevant, particularly over the longer term, to whether that company in question is going to build its value more rapidly than others. And so somebody with a generalist background working with it, if I was in your position, I would work closely with the staff and ask them to help me understand exactly what the most provocative questions in these areas would be. And we've learned that the face of sustainability is very different depending upon what market sector you're looking at. I think one of the best ways you can pursue sustainability is to really drill down on that. Because, human nature is such that when most people are measured by their performance according to that narrow set of metrics, you're going to naturally pay more attention to that than the rest of the spectrum. You've probably seen this video on the internet that has people passing a basketball around with white T-shirts and black T-shirts, and you're supposed to count how many times they touch the ball. If you haven't seen it, I'm going to ruin it for you. Because it's about a 2-minute video, and in walks a big person in a gorilla suit, turns toward the camera and beats his chest and walks out again. And when the video's over, they're asked, how many times did a person with a white T-shirt touch the ball? And they'll say 15, 17, 16. And the moderator says, okay, the right answer is 16, but how many people saw the gorilla? And the astonishing thing is, most people never see the gorilla. Why? Because they're focusing so intently on what they believe they're supposed to focus on, they don't see outside that narrow focus. And that comes back to this investing process. If the pattern and practice that's reinforced in the industry writ large is to focus on that narrow slice, then they don't have attention span left over to look at these other parts of the value spectrum. You all can help guide a continued and constant focus on these broader questions of sustainability and where carbon assets are concerned. It's easy to forget that 2/3 of the reserves and 80% of the coal has to stay in the ground. Well, if you're, I don't want to get dangerously close to some specific case that you may have before. I don't even know what they are, so I might accidentally bump into it. But if there's a proposal, well, let's invest in this company that has all these coal reserves. Can they burn them? If the answer is no, at some point that no answer is going to be translated into a market valuation that may be different suddenly from what it is at any given time. Anyway, I hope I've conveyed what I'm trying to say.
Yes, thank you.
Paul?
Thank you. Very, very interesting. And, definitely we are long-term investors because we have long-term liabilities, so we have to think about our assets over a long period of time. One of the problems we face is the world that looks at us, looks at our assets like every 3 months, every year. GASB requires that we mark to market and report every year. People evaluate the viability of a defined benefit plan by the value of its assets and the funded status every year. And so I'm kind of interested in how you suggest we manage that need to address the status of our fund on a short-term basis, because we're required to. In fact, more and more so. GASB rules are moving more and more in that direction. The bond rating agencies are moving more and more in that direction. How do we manage that need? Because the outside world does look at us that way. The press does look at us that way. At the same time, when what we want to do is be long-term investors.
Well, it's a great question, and Lord knows we're not going to have the answer, the specific answer. It's going to be very tricky. But a couple of observations I would certainly make would be, one, you can think of it as really two problems. One is a investment problem, which I'll get to. The second is a communication problem, and that's way, way above my pay grade. From an investment perspective, though, it is critical that as fiduciaries, you understand what is happening in your portfolio on a frequent basis. Some might argue that 3 months is too frequent, but depending on the strategies, it may not be. Actually, if there's a trading strategy, then 3 months is maybe too long, actually, as it turns out. So certainly, understanding what's happening in the portfolio on a continuous basis is appropriate. On the other hand, going back to the best practice of investing, which is ultimately your fiduciary responsibility, it is long-term. It is long-term, that is, and it's an opportunity set. It's an opportunity that you all have that many others don't have, because you have the luxury of being long-term. And so from our perspective, the investment best practice is long-term across those asset classes, continually communicating that is what you're doing, though you're not advocating your short-term responsibilities to monitor what is going on, but communicate that we are long-term investors, we are focused on our long-term liabilities, and this is how we're doing it, seems to us to be an appropriate strategy. But from an investing perspective, there's no question. If you try to trade, if you want to get into the trading business and be measured on a 90-day basis, I have bad news for you. There's folks who are really good at it and have more information and more capabilities. It is very hard for a pension fund to do that.
Thank you.
Even as good as Chris, he can't do it.
Tom?
Thank you, Mr. Vice President. Your presentation was very inspiring, really. and David, I appreciate your remarks. I wanted to pick up on something you, David, mentioned about our size. And given our size and the the historical prudent man rule thinking, it leads you to basically be an indexer or very passive in terms of your equity investing, and we are, like most other big institutions. Have you seen other, do you have suggestions as to how you square that investment style and philosophy with very firm, sustainable values and direction?
Yes, we absolutely, from a overall portfolio construction and asset allocation perspective, would say that a fund such as CalSTRS should have significant passive exposure. There's no question about that, and there are lots of very strong reasons for it. But then the question is, okay, well, what are the risk implications of that exposure? And that's where it gets to be much more complicated. And historically, what the approach has been for passive investors is to be engaged with those businesses that they own because they have to own the market. And very often that can actually be quite a good active investment strategy, as an aside. But certainly from a fiduciary perspective, it's critical that passive investors are as active as they, or as engaged as they can be. They have to prioritize because there's lots of companies in the indices, et cetera, et cetera. But I think increasingly, it is a fair question to ask whether the risks of certain types of assets in an index is inappropriate to bear. And certainly we would advocate that understanding carbon risks in those indices are increasingly critical. Now, you can take the decision to try to mitigate those risks through indices that have lower carbon exposure. They exist. MSCI has them. You could take a decision to invest in indices that actually overweight carbon or alternatives, and so you can make indice decisions, or you can make a decision to invest in indices that have no carbon exposure. So there are passive decisions that you can take that you should evaluate based on your comfort with the risks of those portfolios. Let me give you another example. If you were a Finnish pension fund, or if you're a British pension fund, you will have a significant, in the case of Finland, they had, the index was, Nokia was something in the order of 56% of the index. So every single company or every single pension fund in Finland was exposed primarily to one company. So if you only are indexing based on that, that's a bad idea. In the case of the UK pension system, which is not dissimilar here, the percentage of hydrocarbons, the energy and materials are something in the order of 30 to 40% of the FTSE 100 index. Thankfully, that's not the case here in the United States. But that is a big risk, a concentrated risk that one needs to be comfortable or not with. So what we would advocate is categorically, climate ought to be, carbon risk ought to be integrated into the investment decisions that you're taking. Certainly from a risk perspective, if that's the only thing you do, that will be an important step.
If I could add just one word, the flip side of the risk management coin is the opportunity recognition coin. And really, David's getting at that too, but where the transition to a low carbon economy is concerned, there are tremendous opportunities there. They have been obscured a little bit in the U.S. because of, Mark Twain famously said, a cat burned on a hot stove won't sit on a hot stove again, but won't sit on a cold one either. And the hot stove in that story for alternative energy and sustainable businesses in the U.S. came when a perfect storm rolled in with the Great Recession, the shale gas revolution, which pushed the price of electricity and some other forms of energy down, the failure of policy in the U.S. Senate and in Copenhagen, and then the Chinese juggernaut, which landed solar and wind systems and some other systems here in the U.S. at a price below what the cost of production was in the U.S. So those four elements together just really created a perfect storm. But there are lots of businesses, including significantly in California, that have weathered that perfect storm and are now looking at these opportunities in Bangladesh and South Sudan. And rooftop solar in Africa is doubling year on year now. And the fact that globally the investment in renewables has surpassed that of fossil and is still growing, that's a signal that there are great opportunities out there. Now, identifying them is really difficult and hard. But as David said about looking at the large categories of risk, looking at the large categories of opportunity is something that a big fund has to do also.
Thank you.
Thanks, Tom. And I'm mindful of time. I understand that Vice President Gore has another engagement. So, but I really appreciate, again, your time here today. Thank you, Mr. Blood, as well. We've said it a lot. We're long-term investors, and I think what we think about a lot, and what we've been talking about since we've wrapped up our funding solution last spring was, as long-term investors, how do we think about mitigating our risk? And we have long-term risk and short-term risk, and I certainly think the sustainability conversation to us is really part of the challenge of looking at risk and I'm concerned about what's going to happen in the next 10, 15, 20, 30 years. So I really appreciate you helping to continue the conversation that the board is going to continue to have around sustainability this spring. And thank you so much for your time. Really appreciate it. So
Thank you.
thank you. Okay. And I apologize, Maggie. We have a few moments for members from the public, and then, so go ahead.
Maggie Yost, Chair of CTA Retirement Committee. I think the teachers in the room would give Vice President Gore and Mr. Blood an A+ on your presentation. We were entirely engaged. We are very proud of this board and of CalSTRS staff for their direction in sustainability. As teachers, we look for the education of our students because it's the future of our world. And at the same time, it's a sustainability about CalSTRS because we have generations of future teachers that this organization we want to support as well as they have for the past 100 years. So this conversation today has been very enlightening. I think it's been very inspiring. I personally, as chair, I have a whole nother level of understanding of where we need to go in investments, and the conversation of divestment and sustainability go hand in hand. They're not opposed. So thank you so much for this conversation, and we look forward to a future engagement about this.
Thanks so much, Maggie. And I did, if the board will indulge, I know we have two more speakers, and so I'd like to give them an opportunity so they don't have to wait through the whole rest of our day to the end. Is that the pleasure of the board? And then we'll break for lunch. So I have Jane Fosberg and then Bill Fosberg. So Jane, welcome.
Thank you very much for your time. Action on climate change must happen now. These are the words from CalSTRS CEO Jack Enos. Indeed, we commend you, CalSTRS, for your commitment to elevating sustainable investments as a key strategic priority to the fund. We also commend you for signing a global investor statement calling for strong worldwide climate policies to accelerate clean energy. However, your preference for shareholder engagement demonstrates a confounding disconnect. CalSTRS, it is now time for you to move from shareholder engagement and begin the process of divestment from fossil fuel companies. Shareholder engagement can be very effective in certain circumstances, but engagement has never persuaded a company to alter its core business model. To ask ExxonMobil CEO Rex Tillerson to keep 80% of his current reserves in the ground, by and large, is futile. His company knows the science, and yet it is not only hell-bent on burning every glob, but it has also declared its intent to discover and develop further wells that equal the current reserves. Relying on engagement also fails to acknowledge the urgency of the climate problem, and it even emboldens the fossil fuel industry to postpone its critical transition to renewable energy. Republican Henry Paulson, Secretary of the Treasury in 2008, when the housing bubble burst, warns of the profound financial risk of delaying action. He says that taking a cautiously conservative stance, that is, waiting for more information before acting, is actually taking a very radical risk. Former Commissioner of SEC Beavis Longstreth suggests that the call for engagement might well be a ploy encouraged by the fossil fuel industry. He states, in truth, if the engagement crowd didn't exist, the fossil fuel giants would by now have invented them. And in light of the parallels to tobacco and lead, who knows the extent to which they did? I need to emphasize here that Paulson and Longstreth are not the voices of the progressive left. They are financial experts from the Republican Party. Shareholder engagement legitimizes talk over real action that the situation urgently demands. Therefore, it is now time for you, the CalSTRS Investment Committee, to instruct investment staff to immediately freeze any new investments in the top 200 fossil fuel companies, and over a period of 5 years, to remove them from your portfolio. This is a very reasonable request. These fossil fuel investments already meet the 3 CalSTRS criteria for exclusion. 1, they violate one of the ESG risk factors, the environmental factor, which states that consideration should be given to how a company is dealing with the impact of climate change. 2, a potential for material loss of revenue exists. Financial experts such as Paulson, Longstreth, Tom Steyer, David Blood, and Al Gore with big banks have warned repeatedly of the global financial disaster that will ensue when the carbon bubble bursts. And 3, they weaken the trust of a significant portion of members to the system. I can assure you that the number of members who distrust CalSTRS' continued investment in the fossil fuel industry for financial as well as ethical reasons is increasing. We are frustrated that our pension funds are undermining the future of our children and grandchildren and all the students that we teach. CalSTRS, this is truly your moment to demonstrate your leadership and financial savvy. According to Beavis Longstreth, fiduciaries need not worry about short-term results. He says, a decision to divest rests on the claim that fossil fuel companies will prove to be bad investments over the long term, and therefore, with foresight that anticipates this result, should be removed from the pension fund before the strengthening and foreseeable likelihood of this result becomes commonplace in the market. That time is now. The future is not going to be like the past, and investors who make money are the ones who anticipate the future. Tom Steyer and the Rockefeller Brothers Fund have already divested their portfolio of fossil fuel companies. Finally, Bob Massey, former executive director of Ceres, correctly warns that the failure to address a fundamental destructive force to the future of an investment policy is, in fact, a breach of fiduciary duty. We call on you, CalSTRS, to follow your divestment policy, move from shareholder engagement, and exclude fossil fuel companies from your portfolio. Thank you very much for your time.
Thank you, Ms. Gosper. Mr. Vosper?
Talk about a difficult act to follow. I've got Al Gore, Mr. Blood, and my wife, and I have to speak after those 3. But I'm Bill Vosberg. I'm from Santa Rosa, and I'm a member of CalSTRS. I'm a retired teacher. I taught for 42 years in the high school system and the junior college system in Santa Rosa. And I'm here today to say, first of all, I agree with my wife. You need to divest rather than engage the fossil fuel companies. So I've come here today to ask you to divest from fossil fuel companies to secure our portfolios and to also prevent climate chaos. When I speak about this issue to colleagues, my union friends, other groups, people say, won't divestment from fossil fuels cost us money, especially if we eliminate high-flying companies like Exxon and Chevron from our portfolios? They ask, also, won't divestment be risky to our portfolios? Well, in short, the answer to both those questions is an emphatic no. It's a loss of money, here's a few snapshots of how well some portfolios have done when they've excluded fossil fuel companies compared to those that still contain fossil fuel companies. The data is out there, and I'm sure that your consultants and fund managers will easily find confirmation of these results. My first quick look at the price increase for the last 10 years for Chevron, Exxon, and the S&P 500 as a whole show this. Chevron increased 166%, Exxon increased 139%, and the S&P 500 increased by 171%. 166, 139, 171. So in a way, those two companies were a drag on the performance of the S&P 500 over the past 5 years. According to the Bloomberg New Energy White Paper dated August 2014, this is a quote, portfolios that exclude fossil fuel companies have the same performance level as those that include fossil fuel companies. Third, according to the Aperio Group, their model portfolio of the Russell 3000 that excluded fossil fuel companies had a yield in the time frame 1998 to 2013 of 10.68%, while the Russell 3000 as a whole for the same time period had a return of 10.63%. Nearly exactly the same results when you take out fossil fuel funds. According to MSCI, they're all country world index investable. Boy, this is a mouthful. MCI, ACWI, IMI index, right? With and without fossil fuel companies, tracked exactly the same in the time frame from 2003 to 2013. And according to S&P Capital IQ, a subsidiary of McGraw-Hill Investing, a hypothetical investment of $1 billion in a carbon-free S&P 500 portfolio over the time frame from 2004 to 2013 would have yielded total profits $110 million more than one that was in the S&P 500. They mentioned that because it was a scholarship fund for an endowment for an organization, how many more scholarships would that 100 million have provided to students? How many more retired teachers would that support with their children and grandchildren into the future? As these examples show, research by a variety of investment and management firms over various time periods and using various benchmarks all show similar results, that a portfolio that excludes fossil fuel companies does as well, if not better, than a portfolio that includes these fossil fuel companies. Now, according to risk, or as to risk, the S&P 500, again, this is from the Aperio Group and the MSCI, the S&P 500 without fossil fuels had a higher Sharpe ratio over the past 10 years. So the decarbonized portfolios have had better risk-adjusted performance than the carbonized portfolios. Secondly, over the past 10 years, decarbonized portfolios have had a tracking error of less than 1%, while good fund managers attempt to get 5% or less. So the long and short of the discussion is if we had divested our portfolios from fossil fuel companies over a variety of historical periods, we would not have lost money. In fact, we probably would have made more. In addition, the investments would not have been any more risky, but probably less risky. Of course, past performance no guarantee of future profits, but as we look to the future, we see challenges for the energy sector from falling. I'm nearly there. Thank you, I'm nearly there. We see falling energy prices. Mr. Gore and Mr. Blood mentioned the challenges to the energy sector in the future. They're going to only increase. So our request is that CalSTRS decarbonizes the portfolio. We can do so without reducing total returns. We can do so without increasing the risks. So we ask you within the next 5 years to divest entirely from carbon companies prudently and carefully. And to do that, will secure our benefits and also help prevent climate chaos. Thank you very
Mr.
much for your time.
Losberg. Appreciate it. Thank you. All right. We are going to take a break for lunch, and I just wanted to give you a heads up. So it's 20 after 12. We will come back at 1 o'clock, and we will start with item 8, which is approval of our minutes, and then we are going to move right into item 13. So consultants, investment folks, we're going to start with item 13, which is our asset allocation study part 1. All right, so see you back at 1. Thank you.